Might retirees get another big tax cut? Hi, it's financial planner Sean Mullaney. Let's discuss. So this week we got bill text on Senator Cory Booker's Keep Your Pay Act, which turns out to be a large tax cut for most retirees, including most affluent retirees. It's just a proposal, but we will talk in this video about its chances in the future. And, I think we got to step back and what is this tax cut? What is this proposal? The big thing this proposal does is it massively increases the standard deduction. If you've watched this channel long enough, you probably know that increases in the standard deduction are very beneficial for retirees. Let's dig into some details. The standard deduction in 2026 would go from $16,100 to $37,500 for singles. For marrieds, from $32,200 to $75,000. And this is for the standard deduction. So this isn't age tested. This isn't income tested. Everybody could potentially qualify for this particular tax cut. It would also keep all these numbers indexed to inflation. That's helpful. It would not touch at all the additional standard deduction for those 65 and older. I believe that's only $2,050 for those single. I believe it's $3,300 for married filing joint in 2026. Small numbers, but every little bit counts, particularly when we're thinking about our taxes and retirement. And I will say, if you look at the Keep Your Pay Act, these increases to the standard deduction are proposed to be temporary. They're proposed to exist for only 10 years. We saw this with TCJA back in 2017. That too was quote unquote temporary. And of course, it became permanent in 2025. It's hard to imagine Congress one day passing this law and then having 10 years go by and then overnight, most Americans have a big tax hike. So I think temporary, if this thing were to become law, is basically a way station on the way to permanent. Well, okay. This bill, though, is not just tax cuts. It's got some tax hikes, some big ones, actually. It would increase the 35% bracket to 41%. It would increase the 37% bracket to 43%. So think about it, you're an NFL quarterback, you're making $40 million. The Keep Your Pay Act would essentially take almost 6 cents on the dollar of almost all your compensation and take it back to the IRS or take it to the IRS. So this would be a massive tax hike on very high earners, 6 cents on the dollar of almost all their income. So that would be interesting. It does have increased child tax credits. Not usually relevant for my retirees, but I think that is generally a good idea for younger families, but that's a different conversation for a different day. What's interesting here about this piece of it is I have argued that the relevant question retirees should be asking themselves is not, are taxes going to go up? The relevant question is, are taxes going to go up on retirees? And it is very possible to design a tax hike that skirts around retirees. And that's essentially what Senator Cory Booker has done here. He's saying, yeah, I want tax hikes, but not really on retirees, other than the most affluent, the most wealthy retirees. We'll come to that later. So that's very interesting to me. This future would have some tax cuts, some tax hikes, but notice the tax cuts go to retirees. They'd go to working families too, to be fair. But this is very interesting to me. I've got some resources on the bill. It's called Senate 4042. These will be in the description below. Here's the bill text. And then Cory Booker's Senate website has a tax calculator. It's not perfect. It doesn't fold in age. It doesn't fold in the additional standard deduction. It doesn't fold in things like capital gains rates. But directionally, I think it would be interesting for you to put in your numbers and sort of see whether you would benefit or be harmed by this bill. Most retirees would absolutely benefit. We'll come to more details on that later in the video. All right, so we got some implications if this thing were to be enacted. First thing is retirees and the standard deduction. Retirees usually claim the standard deduction even if they're really affluent, because to itemize, you have to have either some combination of high state taxes. A lot of retirees, even affluent ones, don't have that. Mortgage interest. Well, a lot of retirees, particularly affluent ones, have paid off their home. And charitable giving, Well, for those 70 and a half and older, the qualified charitable distribution tends to be the way to go for charitable giving, and that bypasses deductions. It's an exclusion from income. It's really good from a tax perspective, but you're not itemizing your deductions. You're marrying excluding that from income with a high standard deduction. So retirees tend to be on the standard deduction, and boy, this makes it even better for retirees if this were to be passed. One of the big implications is you would want more of your income taxed in retirement if this thing were to be passed. It makes traditional retirement account contributions, which is moving income from our high taxed earning years to our lower tax retired years, much more attractive. Again, if this thing were to be passed, but it would make those traditional IRA, traditional 401k, really 403b, 457b, governmental, makes those things a lot more attractive. All right, let's keep going. You say, well, wait a minute, Sean, this thing's called the Keep Your Pay Act. Why should retirees benefit from a Keep Your Pay Act? I thought retirees didn't have pay. Well, they sort of do actually have pay, because let's think about it. Retiree income sources, the two big ones for most retirees, including most affluent retirees, are Social Security and traditional IRA 401k distributions. And what are both of those but essentially deferred pay and growth on that deferred pay? Because, the money was put into Social Security and it grew, or the money was put into an IRA, 401k, invested in financial, instruments, and it grew. So if this Keep Your Pay Act didn't apply to retirees, essentially it wouldn't be allowing retirees to keep what is essentially their pay and the earnings that were generated by what are generally favorable activities, right? We like Social Security fund contributions because it helps keep retirees solvent. We like investing in the financial markets because that generally helps large parts of society, large parts of the economy. It's good to have people retail investing through their retirement in the financial markets for a whole host of reasons, benefits a lot of people. So to carve them out from the Keep Your Pay Act wouldn't be fair and be detrimental, even from the perspective of Senator Booker or others who might support it. So just a quick thought on that. I think retirees should absolutely qualify for the Keep Your Pay Act. As written, they do. All this is doing is touching the standard deduction, doesn't distinguish among income classes and that sort of thing. So that's good. And I just said that part. In my 2025 Bogleheads presentation, I talk about tailored taxable Roth conversions. We talk about this concept in our book, Tax Planning to and Through Early Retirement, which I co-authored with Cory Garrett. And it's this very unique Roth conversion opportunity that leverages the standard deduction to move money from traditional IRAs to Roth IRAs, tax-free. Great opportunity. The Keep Your Pay Act would greatly expand that. And I encourage you to look at the Bogleheads presentation that will be linked to in the description below for more on these tailored taxable Roth conversions, TTRCs, I call them sometimes. But that would explode in a Keep Your Pay Act world. Let's keep going. The hidden Roth IRA. If you've been watching my channel long enough, you know about the hidden Roth IRA. It's not hidden from you. This is using the standard deduction to fund our living expenses tax-free from a traditional IRA, traditional 401k. You say, wait a minute, I took a tax-free distribution from a retirement account. Isn't that a Roth IRA? No, it's a hidden Roth IRA, and it would explode if the Keep Your Pay Act were to be enacted. So that's a big one to keep in mind, and that's a concept I think Americans need to become more familiar with. The vast majority of retirees would benefit from the Keep Your Pay Act. Some would face some small tax increases. Now, look, if you're Elon Musk, I think you would be facing a huge tax increase, whether you're retired or not. But the vast majority of retirees would get a big tax cut because, again, many retirees take the standard deduction, especially in this environment, $75,000 for a married couple. Rare would be the retiree itemizing after the enactment of this thing. And, you would have that much more income against a 0% tax. Now, yes, eventually, if you can get that income back to 37% or 35%, yes, then you'd start paying more taxes, but that's really difficult for a retiree to do. And you say, well, what about my RMDs, Sean? Isn't this thing going to eat me alive when I have RMDs? Well, let's review some numbers. So I went ahead, and if I can get out of this screen, give me a second here. There we go. All right, let's get into some numbers. So what I did was I said, well, wait a minute. The tax hike in the Keep Your Pay Act is the 37 bracket 37 becomes 43, 35 becomes 41. So I wanted to do a little sensitivity test. How much of an RMD would I need as a single person, as a married person, to have $1 of that RMD subject to the new 41% bracket? So I go to the 35% bracket, right? To have $1 in the 35% bracket in 2026, and that should be 2026. Apologies as I edit on the fly. I need to have almost $404,000 of ordinary income. Well, think about this. How much income am I going to have before the RMD? So I posit the taxable portion of Social Security plus other ordinary income, interest, non-qualified dividends, at about $100,000 for an affluent couple. Now, under the Cory Booker standard deduction, I'm getting $75,000 of a standard deduction, $3,300 of the additional standard deduction. So look at this. If we're both 80 years old, okay, how much of a traditional IRA would I need to have to generate an RMD of almost $382,000? If I could get that 382 RMD, then some dollars here would now be subject to not 35%, but 41%, and the Booker proposal would start to hurt me. Let's unhide that. This is incredible. I need $7.7 million in traditional IRAs to generate that large of an RMD at age 80. Okay. And by the way, even this person would still get a net tax cut. They'd have $1 that went from 35% to 41%. But because the standard deduction went up so much, their deductions would be increased by 40,000 plus. They would benefit. So you have to have over $8 million essentially in an IRA at age 80 if you're married to be harmed by the Booker proposal. It's that good of a tax cut for the vast majority of married affluent retirees. But what about the singles? What about the widow's tax trap? This is where we know it goes off the rail, right? Well, not quite. So for those in 2026 to have taxable income subject to the 35% bracket, to have $1, you have to have $256 and some change of income. Well, think about taxable Social Security and other ordinary income. Say it's $55,000. The Booker standard deduction would be the $37,500. You get the additional standard deduction of $2,050. So even as a single person at age 80 in the widow's tax trap, $240,776 to have $1 taxed in that 41% bracket, and oh, by the way, you're still benefiting. How big of a traditional IRA does this person have to have? Let's unhide that, and look at that, almost 4.9 million. So you can have a 5 million IRA, be in the widow's tax trap, be 80 years old, RMD, and the Keep Your Pay Act is still probably a net tax cut. You're not really harmed by it until your traditional IRA exceeds $5 million, give or take. These are rough numbers, but I'm doing this as a bit of a sensitivity analysis. This proves out that the vast majority of even inefficient, affluent retirees are going to be helped, not harmed, by the Keep Your Pay Act were it to be enacted. So let's go to that issue. That's a very big issue. Well, wait a minute. What does this all mean, Sean? And I'll give you some chances of passage. In the year 2026, I'm predicting it now, 0%. Keep Your Pay Act is not going to happen in the year 2026. We have Republican houses. We have a Republican president. This is a Democrat proposal. But okay, so not happening this year. What about the next 2 years? Well, I think it's slightly above 0, but not much. So look, as I record this in late May 2026, likelihood in the 2026 elections that the Democrats are going to do well, take one house, likely two houses. It's still, look, things can happen. I'm not a political pundit, but that's where the wind is blowing. So look, it's not that, but even if the Democrats take both houses, you still have a Republican president. Maybe a Republican president would bandwagon. Maybe Trump just says, okay, this could be popular, I'll just sign it. But assuming that the Democrats, take one or both houses, you still have a Republican president, not all that likely to pass, but it is now just a little bit above 0%. But here's the rub, the future, and this is about direction. So look, I am not here to say that the Keep Your Pay Act is ever going to pass. That's not what this is about. It's about the direction, and it's about where our tax is going to be on retirees directionally. We've now seen with the One Big Beautiful Bill, the Republicans love to cut taxes on retirees. Democrats say, we're going to raise you, Republicans. It's a poker term, right? They say, no, we're not going to do what the Republicans did. We're not going to increase taxes on retirees. We're going to decrease them even more through things like the Keep Your Pay Act. And it's about direction. It's not about this act is going to become law when there's a Democrat president in 2029 and a Democrat Congress. All right, those are both too far out, still very speculative. But what if it was that? Isn't it interesting to see a prominent Democrat proposing a big tax cut for retirees, even with our high national debt and deficits, and even after retirees have gotten big tax cuts? It shows you that the income tax is not all that popular. But commentators tend to say, oh, retirees are going to have all these high income taxes in the future. Well, why? Why are the politicians going to act against their own interests to raise taxes on people who vote retirees? That makes no sense. And we see it time and time again, both Democrats and Republicans delaying RMDs. That came from Democrats, right? Not from Republicans. The first one, to be fair, was 2019. And I believe there was a mixed Congress and a Republican president. But okay, fine. So Democrats are capable, just as Republicans, of cutting taxes on retirees. And that's where the wind's blowing. Again, I'm not here to say this particular proposal is going to pass. But as somebody thinking about taxes on retirees, this is very encouraging. So look, the takeaway here. Retirees tend to be lightly taxed. If Senator Booker has his way, the vast majority of affluent retirees will even be later taxed in the future. So let me know what you think about taxes in retirement, Roth versus traditional, the Keep Your Pay Act. Thanks so much for watching. If you enjoyed this video, please mash that like button and subscribe to my channel. I will see you next time.